Price to earnings ratio, that is PE ratio, is a key metric used in evaluating the financial performance of a company. In this video, we will explore the basics of PE ratio, how it's calculated, and how investors use it to make informed investment decisions. Whether you're a seasoned investor or just getting started, understanding the PE ratio is critical to making sound investment decisions. So let's dive in. Hi everyone, I'm Maishri from Clear. We are India's largest tax and financial service platform where we serve more than 6 million tax filers. Subscribe to our channel to know more about business and taxation concepts. PE ratio is the relationship between a stock's market price and its earnings per share. It's a way to measure if the stock is worth pursuing. A high PE ratio can indicate that the stock is overvalued, while the low PE ratio can suggest that it's undervalued. However, it's important to note that a high or low PE ratio alone doesn't necessarily indicate whether a stock is a good investment, and other factors such as the company's financial health and industry trends should also be considered. The formula for PE ratio is the current market price of a stock divided by its earnings per share, that is EPS. PE ratio is equal to market value per share divided by earnings per share. Here the market value per share refers to the actual price of the share and earnings per share is how much money one share has earned over a specified time period, typically 1 year. Did the explanation make sense so far? If it did, write clear in the comments below. Two companies, A and B, are of the same industry. Company A is selling its share at Rs 100 with an EPS of Rs 25 and Company B is selling its share at Rs 90 with an EPS of Rs 10. If the average PE ratio in the industry is 5x, then Company A has lower PE ratio and Company B has a high PE ratio. In other words, Company A is undervalued and may be good buy for an investor, while Company B may not. However, it is important to understand that there are several other factors to consider before making a purchase decision. The PE ratio is important because it provides a quick snapshot of how expensive or cheap a stock is relative to its earnings. The PE ratio is also useful for comparing the valuations of different companies within the same industry or sector as discussed earlier. However, it's important to note that the PE ratio is just one metric among many that investors use to assess the value of a company's stock. It should not be used in isolation as other factors such as company's financial health, board members, etc. also play important roles in determining its long-term success. Additionally, different industries and sectors may have different average PE ratios, so it's important to consider this when evaluating a company's PE ratio. So folks, I hope you have enough clarity on PE ratio. If you have any questions regarding corporate taxes, please feel free to comment. For queries related to business or finance, you can contact our experts by clicking on the chat link provided in the description box below. Also, don't forget to subscribe to our channel for more such informative videos and stay tuned for more updates. Thank you.